Oil prices edged higher on Thursday as the market balances weak demand with supply disruption amid a looming rail stoppage in the United States, the world's biggest crude consumer. Biden administration led talks between freight rail companies and unions to avert a U.S. rail system shutdown extended into early Thursday morning, with no word on whether progress has been made. The increasing likelihood of a U.S. rail stoppage is adding support to the market, but at the same time, data released by the Energy Information Administration showed U.S. crude inventories rose more than expected last week, suggesting weaker fuel demand and essentially putting a lid on prices. More on this, let's now go to Danni Hewson, who is finance analyst at AJ Bell in Huddersfield. Many thanks for being with us today. Danni, has the market been focusing a little too much on the demand side of things of late and possibly pricing too big a fall in actual demand?
Yeah, absolutely. I mean, markets have been pretty obsessed with the prospect of a global recession, and they have been focusing very hard on the potential that demand would fall. However, at the same time, we've obviously got this issue of supply, with OPEC keeping really close eyes on how much is going into the marketplace in order to keep prices fairly level. I guess it's quite difficult to sort of figure out exactly where demand is going to go, because we have a situation where actually demand in Asia has been softening. We've got a situation where in the United States, as you say, inventories are higher than had been anticipated, which also suggests that demand won't be as great there. But as you say, then we have this rail strike, this imminent rail strike in the United States, which could impact, importantly, crude oil being shipped right across the country, which could, again, create some kind of bottleneck. We've also got the situation where, of course, the dollar is incredibly strong at the moment, and that means that oil prices are high, and when oil prices are high, that tempers demand. So it's kind of a bit like a house of cards at the moment. No one knows quite which card is going to fall next.
Absolutely, Danni. I mean, 125,000 workers might be on strike tomorrow, and there's absolutely something, and all eyes on that. Meanwhile, though, we also have expectations of further U.S. interest rates hikes, essentially clouding the market. What do you expect from the Fed's meeting and the interest rate hike? Is 100% rate hike possible at this point, and what sort of implications would it have?
At the moment, markets are pricing in another 75 basis point hike. So over 80% of the marketplace is anticipating that, following the hotter than expected inflation figures which came out earlier this week. Although overall CPI had fallen, the crucial bit, those core inflation numbers, had trekked higher. And that is something, of course, that the Federal Reserve will be keeping a weather eye on. Would it go to 100 basis points? At the moment, the expectation is probably not. That 75 basis points would be enough to keep up the momentum on these aggressive hikes. It's what the market is expecting. So, of course, any change to that would be some kind of upset. But with these rate hikes, of course, comes a strengthening of the dollar. And as I said earlier, that just impacts the price that people pay for oil, because most oil is transacted in dollars. And if you're paying in a different currency, and your currency is worth less against the dollar than it was a couple of months ago, that is just going to make things more expensive.
Absolutely, strong dollar really having an impact on several markets at the moment. Danni Hewson, many thanks for your update.